Thank you all for coming. I'm Marty Berger. I'm CEO of Silverstein Properties. I'm joined here today by three very serious players in the crowdfunding arena. Darren Powderly from CrowdStreet. Raise your hand. Thank you. Navjot Athwal from RealtyShares. And King Davidson from Fundrise. You'll hear from all three of these experts in their field today. I know the least about this subject, so I'm going to try to shut up and allow these guys to do what they do best. But I'm going to give you my layman's view of what I know about crowdfunding and set the stage. So the credit freeze that occurred during our Great Recession really made it difficult to raise debt and equity. And the Jobs Act of 2012, which stands for Jumpstart Our Business Startups Act, allowed credit to flow again. It allowed for companies to solicit money publicly for the first time in 80 years. And this changed really the whole world of money raising. Akin to Charles Schwab changing the way investors access the markets 30 years ago, this allowed online investing. And people were already buying everything online, so why not extend that to real estate? There have been a lot of technology advancements that have helped make this possible. A, everyone migrating online. B, there was a reduced cost of all these host servers and new software technology in order to create these platforms. And it was good for both consumers and providers. It was a simple access to these platforms and to other tools. There was an article put out by the Wall Street Journal. It was called The Uberization of Money. And they talked about the tech-savvy advisors, robo-advisors out in Silicon Valley that were using algorithms and applying them to portfolios, which just made it more efficient, and using technology to figure out how to trade. Also, exchange-traded funds are very similar. And these eliminated the middleman and required much less staff. So it was a cheaper form of investing. And this sort of helped lead to crowdfunding. So what is crowdfunding? It really started about 8 years ago with a company called Kickstarter, which was helping artists and creative people raise capital. But it wasn't for investment back then, it was for donations. And then after the Jobs Act, the birth of debt and equity crowdfunding really was created. And this was putting money to work for a return. Online capital formation was applied to the internet, was a modern approach of raising money, and now it's applied to real estate. So investor relationship management, this is software that allows for communication, distribution, personal information, offering memorandum, and detailed documentation. When I first met the Fundrise guys, they came to my office and they showed me this platform. And it amazed me that all this was online, that you, as an investor, can go in and they'll have all your personal information. You can see the offering memorandum. You could touch the economics of the deal. You could see the construction budgets. And it was a platform that really allowed the little guy to feel empowered. And then it went to investment banking and advisory participants. Everyone started taking notice of this. So mortgage companies, non-traded REITs, brokerages like HFF and CBRE tried to get in on it. And then some of the larger investment banks and advisors started their own platforms and called it multi-channel fundraising. And now we have both institutional and retail investment capital sources. So the participants are accredited investors and institutions. So there are different platforms, and we have representatives of each of these different platforms. The first we'll call direct-to-investor technology, like CrowdStreet, which is Darren's company. It's really a marketplace or exchange. It allows third-party sponsors to be linked with third-party investors. So CrowdStreet doesn't own the deal. They link the developer or the investor or the deal sponsor to the investors. The second is an investment management type model, like RealtyShares, which is Nav's company. And this is where Nav acts as, or RealtyShares acts as an equity or debt investment manager. They're the sponsor, and you invest deal by deal in individual LLCs for each deal. And then there's the E-REIT, which is Fundrise, which is King's company. They act like a financial manager. It's one offering that you invest in, and it invests across a portfolio of deals. So 3 different types of platforms. And then Darren reminded me that there's also white label software that their firm is creating. So if you are a real estate company and you don't want to have the CrowdStreet name on it, they'll create the platform for you, and you can put your own name on it. So how big is this market? Right now, it's about $2 billion a year. So it's about 2,500 deals a year, 800,000 per transaction. But the potential is so much larger. And it's sort of the modern version of friends and family. So with that, I'm going to leave it to the experts to talk about it. And I'll start with, sorry, I've got to do a little fancy stuff here, with Darren.
Excellent. Thank you, Marty. So, Darren Powderly, founder of CrowdStreet. Thanks for having me here today. It is an honor to be up here with my colleagues in the field. All these guys are innovators, especially having Marty here next to us with Silverstein, and speaking with you about the future of capital formation for commercial real estate. And so and that's really how we look at it. We look at the word crowdfunding is so misunderstood. I mean, you could crowdfund for your favorite band, or you could crowdfund for poor people in a third world country. But what we're really talking about here is the modernizing of how we capitalize commercial real estate, particularly with this panel. And it's sort of what we view as the future of capital formation and investor relationship management for commercial real estate. And it's a very small sliver of the market today, but it's growing rapidly and will continue to grow as the years progress. And I think 10 years from now, we'll see, it'll be a no-brainer. People will be like, of course I raise capital online. You might do it through an E-REIT or an investment manager partner, or you might do it for yourself with a direct-to-investor model, or the next model that is not represented here today that we haven't even seen yet. But there's so much innovation happening so rapidly right now. So I was fortunate enough to found the company in 2013. Actually, I conceived of it in 2012. I had 15 years of commercial real estate and 5 years of technology experience. And today, we're a VC-funded company based in Portland, Oregon. We have 13 employees. And we have a lot of commercial real estate advisors. So we were born out of a commercial real estate firm. And that it gave us the sort of experience to realize that gosh, fundraising hasn't changed for commercial real estate in like 25 years, and particularly in our view of the world, friends and family, fundraising, the syndication. It is so old school that we really felt like if we could apply technology to it and modern tools that we could greatly advance it, and it could be a global opportunity. So we basically stopped doing our day jobs, or I stopped doing my day job, and went after this entrepreneurial startup opportunity. And we really do have deep expertise in commercial real estate as well as private equity and internet software. And we've learned a couple of things in the last like four years or so, really 3 years since we launched. But from our view, again, because we're focused on commercial real estate, owner-operators, developers, and what we call sponsors, who do capitalize their deals via syndication. They don't only syndicate. They have great lender relationships, and they have great private equity sources that they raise capital from. But they like the syndication model, and they're interested in growing that piece of their business. But it's difficult. It's been difficult. It's a viable method, but it's been difficult. As well as meeting new investors is totally challenging. And never mind once if you were able to grow your investor base, then managing those investors is a burden that many sponsors are not equipped to handle. And then clearly, technology is disintermediating, disrupting, Uberization of finance, as the Wall Street Journal calls it. Clearly this is happening in every industry, and it's almost shocking that it hasn't happened more rapidly in our industry here in commercial real estate, but it is happening. So some of the questions that we were posed as panelists were just to kind of explain our different versions and of the business. And so the question was, how does the funding work? What's the model for operators, for those of you who are commercial real estate owner-operators, developers? And the first way that we deliver our solution to you is by a software as a service. It's a cloud-based solution that enables you to set up your very own funding portal on your website for the people that you already know, your investor members, your friends and family, as well as it gives you an opportunity to attract new people to your website, to build your brand and build your business with a whole pool of individual high net worth investors. In our world, they're high net worth accredited investors only, but also private equity firms and funds and family offices and institutional investors of a wide variety can now do business with you directly. And we deliver that solution via our software called Sponsor Direct. The second way, and probably what we're more known for, is our marketplace. We do have, and we're very passionate about this direct-to-investor model where we connect accredited high net worth investors directly to the sponsor, right? There's pros and cons to these different business models, and in our business model, the pro is that it's a very efficient relationship that's being built there, and hopefully once we forge a relationship between sponsor and accredited high net worth investor or institutional capital, that relationship starts and then is repeatable over time and really has a really strong lifetime value. And our marketplace is certainly proven to be successful. We've done over 40 deals. We could have done 400, but our marketplace is highly curated, highly curated. It's our own form of risk management and CYA, if you will, in this new and pioneering world. So we've been fortunate to have a high success rate. When we set expectations for our marketplace, for our sponsors, we've been able to set them low and reasonable, and so we've exceeded expectations by about 114%. Most of our deals are equity, and the average raise is around $750,000, $850,000. So that's how the model works for operators. And then, what are the scenarios and where a real estate investment manager comes to us? Well, the first scenario is that, they have all these existing investors, but, they don't have the right tools. They're not managing them efficiently. It's spreadsheets and it's email. And then they also, don't really have an efficient way to grow that investor base. So they come to us for the marketplace and Sponsor Direct to do so. The second scenario is that they want to raise more money faster, and they want to do it at a lower cost. And so they can utilize either Sponsor Direct on its own and drive people to their website, or they can post a property on our marketplace and meet people that they don't know. We maintain a community of 7,000 investors at this point, again, accredited high net worth investors, and that's growing. It's something we spend a lot of time cultivating our investor community, and we spend a lot of resources and money to build that. But mostly, it's about trust. It's about integrity. It's about introducing them to operators that we have a high degree of confidence in that can take care of them. And then the last one is investor communications and management. They might have a lot of reports and information, but they're having a difficult time of communicating with these people 24/7 in a manner that they are accustomed to receiving reports. I mean, Fidelity, Charles Schwab, any other accounts, of course, you have access to your information in a real-time basis anytime you want to. So why not for commercial real estate in the private commercial real estate space? We deliver a solution that helps companies do that. So our ideal customer, another question that the organizers put together is who's the ideal operator? Because for my colleagues here, they have a different ideal operator, and oftentimes, we'll talk about the pros and cons, and we'll share in some cases, we'll share some clients, and in some cases, it's a better fit for my friends here. But for CrowdStreet, the ideal operator for Sponsor Direct is anybody that wants to have their own funding and investor management portal. They want to have a direct relationship with the investor, and they believe in the future of that relationship. In this day of Uber and Airbnb and WeWork and so forth. Pardon me, I just clicked a couple of buttons. Okay, there we go. And then they really embrace what we call multi-channel fundraising. Multi-channel fundraising is I think a new concept, not for retail. In retail, everyone's talking about multi-channel retailing and e-commerce and so forth. So apply that to the fundraising space. You've got your banks, you've got your private equity firms, and now you're going to have your own direct-to-retail investor, channel, the internet channel. And then that's for Sponsor Direct, which is the SaaS model. For Marketplace, again, it's highly curated. It's a very high bar. 2.5% of the companies that we're talking to actually make it on our marketplace. So it's very low volume but high quality, and we intend to keep it that way. So a case study is Denholtz Associates. We were referred to this group. It's a 60-year-old company out of New Jersey. An existing client of ours referred them to us. And they had a big portfolio, about 25 existing properties that they currently owned, and they wanted to load up deal rooms for these to report to their investors. They have over 250 investors of their own. And so they're utilizing the Sponsor Direct solution to do that. And then every one of their new deals for like a new offering they're raising capital for is posted on their website, of course. And the select new deals are posted on our marketplace, but not all. Only the ones that they want that sort of funding boost, or they want to like meet new investors and grow their investor base with a specific offering. So I'll show you one of those deals. It was called 100 East Pine down in Orlando. It's a value-add office property. And there was a great business plan around this. The property had been struggling for a number of years. You really hadn't come out of the Great Recession just yet. And Denholtz acquired it for a very low basis and put together a very achievable business plan with investor-friendly returns to come in as basically preferred equity participants. So they do this as a model offline, and they chose to partner with us to sort of try out the internet side of things, and it was very successful. We were able to help them raise about $700,000, pardon me, from 15 new investors. It took us about 4 weeks to do so, and the returns were very favorable to the investors. So, the one thing as finishing up on CrowdStreet is that this is not like what's going to happen. And the important part of it, and thank you for joining us to sort of see like the experiences that we're all going through. But some really great companies have already become customers, what we're very grateful for. So we're paying deep attention to these companies that are innovators themselves, that are early adopters, and that are looking to the future of sort of online capital formation and how it's going to help them, grow their business, give them an unfair advantage, and position themselves for success in the years ahead. So thank you. I appreciate you listening.
My name's Navjot Athwal, founder and CEO of RealtyShares. Just a little bit about myself before diving into what RealtyShares is. Spent about a decade in real estate prior. Thank you so much. Spent about a decade in real estate prior to founding the company. Started my career as a real estate broker and then transitioned into real estate law. Spent about 3.5 years prior to founding the company as a real estate attorney in San Francisco, representing mostly large institutional real estate clients like Avalon Bay, SKS, investments, equity residential, related, et cetera, et cetera. In 2010, I was heavily investing in real estate, great time to buy, as most of you know. And going through the motions of trying to raise capital and just realizing how inefficient raising debt and equity, even debt capital at that time, because banks were really pulling back, and especially equity capital through friends and family, going through those motions really spawned the idea of creating an online marketplace to provide more efficiency in capital markets for the small cap real estate space. And when I started working as an attorney, I had a lot of friends who were fellow attorneys looking to get exposure to real estate. They were accredited investors, were heavily invested in stocks and bonds were very low yield, and stocks were experiencing a heavy level of volatility. So the idea for RealtyShares really came through those experiences. And when we set out to build RealtyShares in late 2013, our mission was really to transform how real estate investing works for both passive investors looking for real estate exposure without having to become a landlord and directly operate the asset, as well as active investors, operators, sponsors that are looking to raise capital more efficiently than they're able to do in the offline world. So really our mission, and still holds true today, is to create efficiency, transparency, accessibility on both sides of the marketplace for both constituencies by leveraging technology. So we have a two-sided marketplace. On one hand, we have investors. The value proposition there is really opening up real estate as an investment for their portfolio, really providing them with a way to invest smaller amounts into real estate, having a more streamlined investment process, getting data at their fingertips through their laptop or tablet. And that's really what we provide these investors. We have over 20,000 accredited investors using our platform today and looking at deals, and that number is growing by 2,000 a month. So it's really exciting just to see these investors, come to the platform, get really excited about what we're offering, and invest in multiple properties in any given year. The other side of our marketplace is our operators, our real estate companies. And the value proposition there is really, we're creating efficiency that doesn't exist in the offline world. On average, we're able to raise capital in about a week once that deal is listed on our platform. And we are full stack, so we can provide both debt and equity capital. So really, it's all about efficiency, accessibility, and speed, and that's what we're really setting out to do with RealtyShares and the entire industry in general. In terms of our back history, so again, I mentioned we started in late 2013. We launched our first deal in summer of 2013. And since then, we've raised about $32 million in venture capital. Most recently, we closed our Series B round. That was $20 million earlier this year, and that was led by Union Square Ventures. They're a heavy fintech investor, invested in Lending Club, as well as non-fintech companies like Twitter. Now we're about 50 employees. We're based out of San Francisco. And we've really been able to use that capital that we've raised and add a lot of bench strength. A lot of our team members have been in real estate, private equity, and real estate investment companies. Our VP of investments formerly was a VP at BlackRock. So really building bench strength on the real estate side to more accurately assess and underwrite deals, but also on the technology and product side to continue providing a great user experience for both sides of the marketplace. So we're really excited to have great venture partners as well as a great team to help accelerate the growth that we've already experienced. We also just hit a new milestone. We raised our $150 million through the platform. We just hit that milestone in March. Most of that was in the last 15 months, and we're doing about 15 to 17 million a month of capital formation through the platform. So really exciting to see that growth, and that's really through the accredited investor base that we have today. So there are misconceptions about what is crowdfunding, and I just wanted to go through what we are and what we aren't, so you have a really clear understanding of what this concept of online syndication, at least through RealtyShares, is. Again, my fellow panelists may have a different view, and you've already heard Darren's view. You'll hear King next. So one is, again, we're only open to accredited investors. So we're not catering to retail investors or non-accredited investors. We do have a constituency of family offices and larger investors using the platform to get exposure to middle market real estate, but again, they're all accredited. Two is, when we set out to create this company, we really wanted to address the part of the real estate market where capital inefficiency is the greatest, right? So doing $3 million raises for a $100 million real estate deal isn't really moving the needle. So it's really those deals that need anywhere from $500,000 up to $5 million of equity capital, and we're slowly inching higher than that is what we're really focused on. So we call that the sub-institutional, middle market, small cap. There's a lot of names for it, but that's really what we address. That's the market we're going after. I come from land use. I was a land use attorney, and I used to work in San Francisco. It's the most infamous for getting development projects done. So I learned, from those experiences that the process of going through entitlements is just too uncertain for the constituency of investors we have today. So all of our deals either have to be cash flowing or have to be fully entitled, ready to put sticks in the ground. We are a curated marketplace. So there is a vetting process you have to go through prior to being able to list deals through the RealtyShares marketplace. And then finally, we only do U.S. projects. Most platforms do. And we've done deals in about 60 markets. We mostly focus on secondary markets. Again, that's where I think more of the sub-institutional or small cap real estate is. So high growth secondary markets where there's a little bit more yield potential, and that's what our investors are really looking for. All right, it's going backwards now. Okay, so in terms of the products we provide, so for commercial, most of our products are equity. So we provide two types of equity products, a preferred equity product as well as a JV equity or common equity product. We're pretty broad focused in terms of product. We've pretty much done every food group from multifamily to retail to hospitality, as well as self-storage and industrial. Most of our deals have been multifamily and retail, but again, we've done it all. On the preferred equity side, actually on both sides, we're typically able to raise anywhere from $2.5 to $3 million. That's where we top out today. Our average deal size on the commercial side is typically $1.5 million. That's what we're raising on a per transaction basis on average. Investment durations on the preferred equity typically top out around 36 months, although at times we can go a little longer than that. And the return requirements that we've seen work on the platform are shown there. And we could fund up to 90% of the total cap stack on the preferred equity. So if you have a first lien loan that's 70% or 75%, you need additional bridge capital, we can provide that with the cap return structure. On the common equity side, very similar in terms of transaction types, and investment size, a little bit more flexibility around duration, We've done deals that are 7 to 10 years long, but we typically like to keep them at 5 years or less. And those are some of the sort of the waterfall terms that we'll see that are most typical. We can fund up to 90% of the total equity required. We always require a 10% net co-investment, but we're very flexible. I think one of the benefits of online platforms and RealtyShares in particular is flexibility. So we can be part of the LP capital stack. We can be a majority LP. So we're very flexible, and we always want to find a way to work together as long as the deal is good and the sponsorship is good. So we don't turn down deals just because they don't squarely fit within our structure. So that is one benefit of using our platform. So one thing to mention, although most of our products have been equity, we also can fund debt. That's a new product for us. Mostly bridge loans is what we're funding. So if you do have needs on the debt side, we can couple an equity transaction with the debt, with debt capital as well. So that's something to keep in mind in case you're looking for a full stack solution. In terms of how the platform works, so two-sided marketplace, as I mentioned before. Let's start with the investors. So we actually verify the accreditation of each investor prior to allowing them onto the platform. We are affiliated with a broker-dealer partner that does 3 different checks on each of our investors. They do an OFAC check, they do a suitability check to make sure the type of investments we're offering, highly liquid investments, are suitable, as well as an accreditation check. So the investor needs to go through all 3 checks before they're allowed on the platform to start investing through the marketplace. On the sponsor side, the next slide will take you through a pretty robust funnel that a sponsor needs to go through before being able to list deals on our platform. But essentially, once that sponsor and deal are approved, then it's launched onto the marketplace. The transacting between the 2 sides happens directly through the marketplace. Then I think one sort of differentiator or difference that we offer is, again, we try to do as much of the legwork as possible, both on the front end when we're raising the capital. We pretty much, your job ends as an operator once that deal is approved, and then we come back to you at the closing table and say, look, we obviously keep you informed during the process, but hey, we've raised $2 million or $2.5 million. What's your wiring instructions? We review the operating agreement before the deal launches. So we're pretty efficient in really allow you to keep your eye on the ball, which is getting that deal to the finish line rather than having to worry about the capital formation element. And then we're also an ongoing partner. So we help service the investors. And the way we do it is we actually set up a separate single-purpose vehicle. It's an LLC. It's managed by our subsidiary. And that entity is the entity that pools the investors that participate through our platform at 5K check sizes and up. On average, you'll see investor participating at about $15,000, but $5,000 is the minimum. And then that SPV is a single investor in your deal level entity, whether it be a limited partnership or limited liability company. And that way it shields you from the potentially dozens of investors that participate through our platform. And we sort of take care of the headaches of K1s and distributions directly through our platform for that base of investors. So again, it's the marketplace, the transacting, the fundraising, as well as the servicing component that we do provide. So here's just a high-level overview of our funnel and our vetting process. Each month, we're getting about 1,500 applications from operators. A lot of them are rejected right off the bat because they don't have the track record requirements we're looking for. We're really looking for operators that have a pre-existing track record and really are trying to scale their business and need more capital access to do that, or just need more efficiency around raising capital. So we'll pre-qualify. That's a pretty automated step. Once that deal is pre-qualified, one of our investment team members will be in touch to just collect documentation and data on you as well as your deal. That deal will then proceed to an underwriting, will be approved by an investment committee. That consists of our chief credit officer, our VP investments, or VP of asset management, and myself. And then that deal will proceed to be listed onto the platform and funded and closed. All in for a commercial transaction from start to finish, we've seen around 25 days is what it's taking. The fundraising portion of that is about a third of that time frame, and then the rest is really the diligence and underwriting. For repeat operators, we can be even quicker because we typically have all the data already, at least on the operator and the principles of the company. So I want to take you through 3 quick case studies, and I can stop Am I good? Okay. So this is a very sort of representative transaction in terms of size of deal. This was a retail deal in Las Vegas. The purchase price was around $13.7 million. Hold period projection was 5 years. It was 92% occupied with credit tenants like Chipotle, Subway, et cetera. We funded a portion of the third-party equity. So that the capitalization structure was $10 million of debt, $380K, 10% sponsor equity, and then third-party equity, and we were a portion of that. We were about a third of it, so we were $1 million in this transaction. That just goes to show the flexibility of being one LP or the only LP. It really just depends on what you need. The waterfall structure there was an 8% preferred return, a 60-40 split above that, and quarterly distributions made by the sponsor during the whole period. So that's one example of a JV equity deal we've done. This is a much smaller transaction, but it's a representative preferred equity transaction, multifamily deal in Oakland. This was a purchase price of 2.8, but with all the rehab work, it was a total cap of around 3.5. We funded $1 million in a preferred equity structure, and that structure was 8% current pay during the hold, and then that was a monthly or quarterly actually, and then a 7% accrued dividend at exit. So it was a capped return with us providing $1 million of preferred equity. And then finally, this is an example of a transaction we actually funded early on, one of our first transactions, mixed-use Chase-anchored building in Phoenix. That was a $5 million purchase. The projected hold was 2 to 5 years, but ended up being a little less than 3 years. Actually, and less than 2 years. It was 93% occupied at time of exit. The capitalization there was about 50% debt, and the rest was in the form of equity, and we funded, again, a portion of that equity. So that just shows some representative transactions. Again, we have done over 300 transactions now across $150 million raised. We also do residential, so that makes up a large portion of that. But yeah, really what our motto is continue building leverage for the operating partners and the investors, and our goal really is to continue moving that check size up, right? So we want to be able to provide you as an operator a single source of capital at $5-7 million. Today we're around 2.5, 3, and we've doubled that every year. So we're hopefully by middle of 2017 we'll be closer to that goal. And thank you all for listening.